Gold has touched over $2,000 just this morning. Extremely volatile because we're now trading back at 1980. The question now is how sustainable is the move in gold? Like the global financial turmoil in the banking sector is causing a flight to safety. Gold is proving to be a safe haven investment, but how sustainable is the whole that gold price move right now? We've moved very quickly from roughly 1,800 now to almost $2,000, and I think I've invited probably one of the best guests you could ask for on this topic. He is a fund manager, but also the author of the In Gold We Trust report, probably the most respected gold report in the sector. And Ronnie, thank you so much for making the time this morning. I know you must be insanely busy right now.
Hi, Kai. Good to see you. Yes, I didn't sleep too much over the last couple of days, but actually, I told you before, it's those days are really, you learn so much, and I like the intensity of markets. So I try to do the best for our funds, for our clients, for our followers, and actually I like it when it's game time.
Absolutely. Isn't that what we live for? We do want to see the financial world burn to a degree as a gold bug because it just proves the case for gold, doesn't it?
It does, yeah, but I think we in the gold scene should get rid of the term gold bug and calling ourselves gold bugs. I think it's I just don't like the term because I don't know any bond bugs or convertible bugs or real estate bugs. I think it's we're just interested in sound money. That's what it's all about.
Absolutely, absolutely. And the world has changed again over the last, 48, 72 hours, like with the, Credit Suisse UBS situation. Do you think the problem is solved now? And since it's very topical, we got to start there, I guess. But it all started with the banking crisis and, with the Swiss now stepping in, offering the guarantees, making the merger happen between the two major banks. Do you think we've extinguished the fire there?
To be honest, I don't know, and I think if you want to try to read and understand the balance sheet of a big bank, good luck with that. So I'm always a bit cautious when people try to make the easy calls regarding our financial system, and those are the guys that completely get everything when it comes to the COVID crisis and afterwards the geopolitical crisis and so on. So I have to say, it's basically impossible to say this is it. This banking crisis is over. However, I think that if we take a step back and compare it to the great financial crisis, I think it would be naive to believe that the current crisis will play out similarly to 2008 and 2009, because back then I think, if you want to go with the analogy of a fire, I think back then basically the firefighters were kind of unprepared. I think they came too late. They didn't have the tools to control the fire. Now I think over the last couple of years, I think it changed dramatically. I think we're always criticizing regulation, especially bank regulation, but I would say from a structural point of view, the majority of banks is definitely much more stable compared to 2008 and 2009. However, as I said, back then the firefighters didn't have enough tools. I think now the big risk is that they will put out the fire, but actually use way too much water, and people might drown in this liquidity. So I think the price of gold, but also Bitcoin, is already reacting to that. And if we compare the sequence 2008, 2009 to the current sequence, I think there's still some similarities. When did gold make its lows? When it initially reacted to this kind of disinflationary, deflationary setup in the system, where we had a panic in the banking system. where basically the whole monetary system was contracting. Gold was actually sold down, but then made its lows already in October 2008. And I think miners made their lows a little bit later. Silver made its lows in November. But equities and commodities only made their lows in March 2009. And I think that if we compare it to the current setup, it could be the GFC in let's say in warp modes, so significantly faster when it comes to this sequence. So perhaps I think that gold really is now in a very, very interesting situation. I call it the mother of all cup and handle formations. While I think for commodities in general and the equity markets, I think we're still in a very, very tough spot, and I don't expect that markets will calm down over the next couple of weeks.
Okay, Ronnie, you posted, coming back to the cup and handle chart you mentioned, you posted that on your Twitter account earlier this morning as well, with a price target of $2,800. My question is, you're Austrian, I'm German. We always look for the negatives first. Like, what could stop a run in gold price right now? Like, what put a halt to the whole rally and maybe stop a secular bull market? And there are other crash prophets out there that are calling maybe for $1,200 gold fairly soon as well. Like, do you see a scenario where the gold price run could actually stop right now?
Of course, it can happen. First of all, I have to say, I think that Germans tend to be much more pessimistic and negative than Austrians. We still kind of try to make the best out of everything. But I think, if we take a step back and try to understand the big picture, the last couple of months were actually extremely disinflationary. So let's not forget that gold held up against this disinflationary setup dramatically. So quite well, I would say. So real yields went up significantly. We have seen that actually compared to 1 year ago. I mean, I don't know any strategist, any analyst out there who actually forecasted that interest rates will go from 0 to roughly 5% in a year. Nobody saw that coming. And I think if we have a look at real yields, gold should actually be trading significantly lower. So the fact that gold has held up so well against this huge move in real rates is, from my point of view, a sign of strength. Now, I think we can all be sure that central bankers will do everything to avoid another great financial crisis, and we have already seen very dramatic measures recently. So for me, last week was basically the confirmation of something that we already saw over the last couple of weeks. If you follow my Twitter account, for example, the pivot is in. So I think over the next couple of weeks we will see, although we are seeing a FOMC meeting on Wednesday, perhaps they will still hike 25 basis points. I think it would be a colossal error. However, the damage has already been done. And Kai, let's face it, it's not just the struggles that we are seeing in the banking system now with SVB and Credit Suisse, and before, two other very much tech-related banks. And I think that's important to say, that those 3 banks in the US that went under had the majority of their clients in the tech space. And the tech space obviously is highly dependent on cheap liquidity and low rates. But before that, we have seen, FTX, we saw the UK gilt market basically collapsing in a week. We saw major problems in Japan. So I think, we have seen basically it was a kind of a train wreckage in slow motion. So it would be naive to believe that now when the pivot is in, everything will be fine again. Yeah. In Vienna, we would say it's happy peppy. So we will still, we financial market guys, we think that, everything is discounted right away. And business owners, investors, retail people that perhaps have a mortgage, have a huge loan, have credit card debt, they only slowly realize what this enormous surge in interest rates actually does to their financial situation. So even if they start cutting now, and we always said that actually the pivot is first of all reducing the size of rate hikes, then pausing, and then hitting the panic button. Even if that happens, it would be naive to believe that everything will be fine then right away, because I think the recessionary clouds are getting darker and darker. We are seeing, it's not only the yield curve, which is the most reliable recession indicator. We saw most of the leading indicators actually clearly showing that a recession is coming. We saw tax receipts in the United States down significantly. So I think going forward, a recession is clearly the setup that we should all prepare for. Now, to answer your question, gold actually does really, really well in a recessionary environment. Why? Because normally that's the environment where not only monetary policy but also fiscal policy starts liquidity injections and starts trying to compensate and trying to avoid a major recession. And we have already seen those liquidity injections. Quantitative tightening is dead. If you have a look at the balance sheet of the Federal Reserve, up 300 billion in just a week. We haven't seen any moves on the rate side yet. This is gonna come. And I think that, and that's the big lesson of the 2020 crisis, fiscal stimulus is now becoming more important than monetary policy. And this will also start kicking in as soon as the recessionary clouds are getting darker and darker, because let's face it, we've got an election year coming up. So I think this combination of changing tides when it comes to fiscal, but also monetary policy, this is really the perfect environment. And if we come back to 2008, 2009, what happened in gold after this initial collapse within the financial system? Well, actually, gold went from 850 up to 1900 over the course of 2.5 years. So that's really my scenario that we're positioning ourselves for. And the downside would be actually, well, everything is going to be fine again. Trust is coming back into the system right away. The Federal Reserve has not broken anything. I just don't see that.
Yeah, it's tough to believe that, because let's say looking at the DXY this morning, it doesn't look like trust is coming back into the US dollar, for example, which would be a reflection of exactly that. And the DXY is down this morning against the other world currencies, for example. The other question is lots of liquidity being pumped into the markets, like a lot of liquidity being provided to the banks. Do you see that impacting like inflation in general at all? Like, do you see that money coming out somewhere else instead of just the banks? Do you see that liquidity maybe jumping up in the real estate, or like people shifting from other assets, like people that had $200 billion with SVB? Are they just going to park the money like nothing happened, let's say with the Bank of America or JP Morgan tomorrow?
Well, that's actually the big topic in the United States. I talked to a couple of friends in the US, and they say, well, actually, if people and especially companies really start taking their money away from all those regional banks that are really the core of let's say the real economy, and if they move it to Bank of America, Citi, and JP Morgan, of course, that's going to cause major problems, because let's face it, no bank can actually survive if 20% of their deposits basically are taken away within a short time frame. So I think the regulators are clearly working on that. There's some sort of an initiative that the FDIC basically guarantees all deposits at those small and regional banks. So I think that's something that will be kind of contained. But as I've said, such crises are if we try to understand the big monetary system, they act disinflationary or deflationary. So I think we are now moving into an environment where the countermeasures that will be taken are actually, they will of course act inflationary in an environment where actually inflation has come down, but we are still not at 2%. So I think this is kind of the inflation roller coaster that we have been forecasting. And that's, I mean, I really don't want to be in the position of Jay Powell at the moment. That's going to be really tough to navigate. So I could see that they try to appear hawkish on the rate side, but then come up with new tools, new forms of quantitative easing to really contain the troubles that we are seeing in financial markets. So I would see further disinflationary pressure. If you have a look at inflation expectations over the last couple of days, they came down significantly. So that's basically confirmed. We're now break-even inflation rate is at 2.3%, which is way below its highs that were at I think 3.5 in March 2022, and therefore I would say that for this could also reduce the pressure on the Federal Reserve to stay that hawkish. However, they are laying the foundation for the next inflationary wave.
Yeah, they'll have to jump in at some point. I keep looking at the real estate market. Like everything's screeched to a halt pretty much. It all stopped. If you look at new house builds, new house, like sales of houses, and just even new mortgage approvals, everything's dropped, right? So if they stop and even lower rates, they'll just jumpstart that again. I don't think it'll contain anything. So I keep looking at that. I think we're just, kicking the can further down the road, in my opinion. But Ronnie, you're also a fund manager. You're an asset manager, right? So navigating this, okay, it's fun to read in the newspaper, but actually putting things into action, you need to act on the information you have. Like, what are you doing today? Like, how are you shifting assets around, or how active are you shifting assets around, and what are you shifting them into?
Yeah. As I've said, it's super interesting these days. I think as an analyst or as an asset manager, those are really the days, the weeks where you learn the most. And I love volatility. I think there's markets or life without volatility are just, don't like it too much. So we actually embrace the volatility that we're seeing, and we're very, very active. I think in general, 2023 and probably also the years ahead will be the time when very, very active asset management is becoming more important again. I think that the time of just buy the ETF long only, that should be over for the time being. What are we doing at the moment? We have increased our position in gold over the last couple of days already. We're slightly cautious when it comes to silver. Just have a look at the gold-silver ratio. It is actually reacting like it should. Have a look at the copper-gold ratio, which is breaking down. So that clearly confirms that probably for the time being, it will commodities will be in a tough spot. Have a look at the lithium market, for example. Oil, obviously. So I think they are still. That's going to be the next stage where you probably should work on your watch list. Put in some stink bits in the commodity space in general, but initially gold, afterwards silver, gold and silver miners, and then only commodities will probably reacting to those measures that will be taken. So what we did, for example, today, and this is a bigger trade that we have been setting up. We're doing call spreads on the big names in the mining space. Why the big names? I know that there's better names out there than the large cap miners, but still, for the time being, I think gold is close to new all-time highs. However, Western financial investors don't really have any allocation in gold, and even less allocation in the mining space, in the gold mining space. Now, what's the normal reaction if the typical generalist comes into a market? Well, actually, they buy the big stuff. It's like, if they want to have gold allocation, they go for the Barricks and the Newmonts and the Agnicos, for example. That's just what's going to happen. So we are building big call spread positions for some of those names, pretty short term options actually. Then we're putting in, as I've said, some stink bits in the commodity space. We have basically sold most of our or reduced most of our long duration assets. We've been very, very aggressive on the rate side. But what happened, for example, not only in the 10 years, but also in the 2 years, last week was like really historical moves. Yeah. So I think that cannot continue. And I think the big trade going forward is definitely the pivot trade, and we prepared some really nice charts on that, where we compared different asset classes to previous points in time when the Fed did a pivot, and that basically confirms my setup that gold, silver are reacting first, and then commodities, equities, and so on, they react with some sort of a time lag.
You've brought up charts. That reminds me to ask you about your chart book that's coming out. Like, I don't really envy your job right now, because things are changing by the minute here, and you're coming up with a chart book this week. Like, how often have you changed charts? How often have you updated them in the last 24 hours? And what chart are you most excited about?
Well, actually, I mean, I've got a fabulous team. Otherwise, it wouldn't be possible. And we're working 24/7 already on the upcoming Gold We Trust report. So of course, building new charts, updating charts, that's our daily business. I mean, that's what we're doing for our readers, for our premium partners. And the new chart book will be published probably on Wednesday, and it's a preview chart book to the new In Gold We Trust report. So lots of new charts. And I think one of the most exciting charts is actually this comparison that I've talked about at length between the GFC 2008, 2009 and the current setup. I think there's many similarities, and therefore I think if we try to really understand the sequence of events, I think as an investor that will probably give you a major advantage. And as I've said before, Kai, I think last year, well, actually, who really bought gold? It was retail investors, it was also Asian players, and it was central banks. Mostly due to the geopolitical events that we are seeing, and we haven't discussed them yet. Yeah? It will be a major topic of the upcoming In Gold We Trust report. But Western financial investors have not participated in this rally yet. If you have a look at ETF flows, for example, they actually they have sold most of their positions over the last couple of months. So the typical Western financial investor doesn't really have a big gold position at the moment. And I think, we know FOMO, we know that they're very pro-cyclical. And I think as soon as we hit new all-time highs, I think this is going to be the catalyst for the next stage of this gold bull market.
Yeah, I always said we need to scare the 401k money. That's the retirement savings accounts in the US. We need to scare those investors to come back into gold, and it seems like we're scaring them plenty right now. So we should be having a few good weeks here, or months, years, whatever time frame we want to use. But it's looking up, right? Ronnie, this was extremely important to me to have you on. I think it was a really valuable discussion. I really appreciate your time. Unbelievable that you found half an hour today to talk to us. I really appreciate it.
Guy, thank you. Will be interesting over the next couple of weeks, indeed. Lots of stuff to write, to talk about, and yeah, follow my Twitter channel. I try to put out interesting, relevant information really quite on a regular basis. And then 24th of May, that's the big date when we publish the new In Gold We Trust report.
Phenomenal. We'll definitely link to the website below because you have a newsletter as well, so everybody gets an alert when it comes out, obviously. And Ronnie, if you have another 30 minutes, one of these days, the geopolitical side we haven't even talked about, Saudi Arabia and Iran moving closer together, what impacts are going to, what is that impact going to be on the world, actually? Be really curious to talk with you about that in a part 2 at some point. But I know you're busy. I'll let you go now. Thank you so much for your time, Ronnie. Really, really appreciate it. Everybody else, thank you so much for tuning in. We hope you enjoyed this episode of Soar Financially. Very, very topical. Of course, we had to talk about what the fallout of the current banking crisis is on gold. We touched on $2,000 this morning. We'll see if we get back to it. Right now, we're trading more closer to 1975, but the trend isn't broken. This is a technical correction, in my opinion. I think we're in a secular bull market for gold. Ronnie's pointed it out fantastically. So make sure to follow up there. The chart book is coming out. Look at that coming this week. Sign up to the newsletter. I'll put the link down below. And if you haven't done so, subscribe to this channel. We'd really appreciate it. Thank you so much for tuning in. We'll have lots more coming up. Very, very topical discussions. Thank you so much.